You're watching Friday Takeaway. We're going to be looking at two oil players that reported earnings this week, Velesto Energy and Petronas Dagangan. First up though, it's round two fight as the US and China escalate their trade war. The US's 25% tariffs on an additional $16 billion worth of Chinese goods kicked off Thursday, and China has promised to retaliate, bringing the total value of affected goods to $100 billion. This is happening even as mid-level officials from both sides are meeting for talks in Washington. No one is expecting an easy compromise. China is not showing signs of giving in, and remember, Trump has threatened to impose duties on all of the over $500 billion of Chinese imports in an effort to protect American businesses. According to Reuters, economists reckon that every $100 billion of imports affected by tariffs would cut global trade by around 0.5%. And veteran economist Hu Keping has reportedly warned that if a trade spat continues, Malaysia is likely to fall into a recession, which could last until the end of 2019. Yikes! Malaysia is already over 1 trillion ringgit in debt, which is why PM Tun Dr. Mahathir told his Chinese counterpart Li Keqiang on Monday that the $22 billion ECRL and gas pipelines projects were a definite no-go. So far, China seems to be taking it well. The relationship between the two countries seems amiable, but we'll see what happens when it presents Malaysia the compensation bill for axing the deals. Oil and gas counters in general are seeing interest after a bump in crude prices on Wednesday. That's thanks to a decline in US commercial crude inventories, which is good for an upstream player like Velesto Energy, which would ride on the price increase. But if the upswing turns out to be unstable, a player like Petronas Dagangan may prove slightly safer as its business is more on the retail side. So let's see how they fare. Velesto Energy, formerly known as UMW Oil and Gas Corp. It's an oil and gas services provider offering drilling operations, pipe manufacturing and oil field services. Velesto remains in the red, although its 2Q net loss more than halved year-on-year to 24.1 million ringgit. CGS-CIMB says the results were disappointing, with jack-up utilization falling to just 59% from 65% in the previous quarter due to operational delays. Plus, two of its jack-up rigs were a little too efficient, completing their work 2 months early, which meant a shorter than expected employment period. To make things worse, Afin Huang Capital points out that daily charter rates are unlikely to see any improvement, at least over the next 1 year, because of the oversupply in the market. The good news is, things are expected to look up in its second half. Petronas has agreed to pay for Velesto's rig mobilization and demobilization costs, starting from the Naga 3 and Naga 5 contracts, which will start this month. More importantly, utilization rates look set to improve. Maybank IB, for one, is looking at an effective average utilization of 92 to 96%, which it says should see Velesto returning to the black in 2H. It estimates core losses to narrow to 12 million ringgit for FY18 and says any short-term weakness in share price due to the soft 2Q results is an opportunity to accumulate. On the whole, we are looking at a consensus buy rating on Velesto with one whole call by M Investments Bank, which last issued a report on the stock before it announced its results. Target price ranges from 24 cent to 35 cent. Despite the optimism, few investors seem to be willing to bet their money on Velesto, at least until it displays a more sustained earnings trend. The stock is currently down by about 15% from 33 cent 6 months ago. On to Petronas Dagangan or PetDag. In case you've been living under a rock, PetDag is the arm of Petronas, which retails and markets downstream oil and gas products. PetDag saw 2Q net profit climb 28% year-on-year on improved margins. Currently, 90% of PetDag's profit comes from fuel. However, the company wants to change that. So the plan is to grow its non-fuel segment, which currently makes up 10% of group earnings, to 30% in 2 to 3 years' time. For instance, its partnership with co-working space provider Common Ground to transform a petrol station into an innovation hub. Common Ground would give them 2 income streams: rental income and revenue sharing. It's also looking to duplicate the business model by transforming other stations in Malaysia and possibly in South Africa. Kenanga believes PetDag's non-fuel target is fairly ambitious. On the one hand, it says the fuel price maintained since GE14 is conducive for the company to plan better. On the other hand, this may affect PetDag's cash flow to facilitate the purchase and selling prices, but the fixed fuel prices may drive volumes. Meanwhile, TA Security says PetDag may see muted earnings traction supported by a high base effect for oil price, which implies lower inventory lag gains. FY18 results could also suffer from margin compression at the retail LPG business. Analysts are kind of split on this one, 4 buys, 4 holds and 1 sell, with a ceiling target price at 30 ringgit 8 cent and the floor at 24.13. PetDag is currently trading below 27 ringgit. It's up by about 5% from the closing price of 25.54 6 months ago.